Hello and welcome to the quarterly performance segment of Making Sense of Markets Q4 2016. My name is Sheldon McFarland and I serve as the Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for this segment. Let's begin by looking at a macro view of performance around the globe. Returns often differ in stock markets around the world, and this quarter was no exception. A snapshot of performance for the fourth quarter shows that returns were positive in North America, with other markets around the globe declining slightly for the quarter, mainly due to a strengthening dollar, which gained 6.4% for the quarter. Returns in US dollars for the quarter look something like this: North America up 3.4%, South America down 0.9%, Europe, Middle East, Africa down 0.5%, and Asia down 3.5% for the quarter. A snapshot of performance for the year shows that returns were positive in most major regions around the globe, except for Europe, Middle East, Africa, which was down slightly. Returns in US dollars look something like this for the year: North America up 11.6%, South America up 31%, Europe, Middle East, Africa down 0.7%, and Asia up 3.9% for the year. Looking at performance by size and style using investment style boxes, which divide the market into 9 performance boxes and are meant to give an indication of how different styles of companies performed, we see that in the US, small value companies, located in the dark green box at the bottom left corner of the style box, outperformed the other company styles, with both value and small company styles doing well overall in the US. Turning our attention to international stock markets, we see large value companies, represented by the dark green box at the top left corner of the style box, outperformed the other market styles. If we stretch our look back over the last 12 months, we see a similar story in both US and international markets. That is, both value and small companies outperforming the other segments. Looking back over the last 15 years, we see a similar trend, both US and international stock markets rewarding investors who stayed invested, specifically in the small and value segments, with 15-year annual premiums of 1.5% and 1.7% for US small and value companies on average, and 4.4% and 1.6% for international small and value companies on average. Investors who stayed invested and followed our strategy of tilting their portfolio towards small cap and value companies both in the US and international allocations of their portfolios were rewarded with higher returns than a non-tilted portfolio over this period. Now hold on, before you run and put all your money in small cap companies, remember this: outperformance isn't guaranteed, and it's impossible to predict when outperformance on something like small companies will occur. In this example, we see an investor looking at the prior 12-month performance at the end of October. They would not have been impressed with their small cap holding, which underperformed large cap by 0.15%. However, step forward 2 months, and by the end of the year, they would have seen outperformance of over 9%. This goes to show that in order to capture small cap premiums, or value premiums for that matter, you have to maintain consistent exposure. Maintaining consistent exposure can be difficult though, and 2016 is a perfect example. Although the return on US small companies was positive for the year, the return was anything but a straight line. The segment started the year down 16% to mid-February, before rallying by 44% for the remainder of the year. This chart reminds us that even a positive year will have its ups and downs along the way. Looking at the most recent quarter's asset class returns, we see asset classes in your portfolio ranging from a positive 8.8% for US small companies on the high end to negative 2.7% for international small companies on the low end. Maintaining a diversified asset mix, such as the 65% stock, 35% bond mix shown in white, kept you away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in your portfolio. To review this or past market commentary, please see the Making Sense of Markets portion of Loring Ward's YouTube channel.